Good evening, ladies and gentlemen, and welcome along to this IC Markets webinar, What You Don't Know About Candlesticks Will Cost You. My name's Chloe, I'm with Trade with Precision, and I'll be with you for the next hour or so. We'll have a look through the markets and talk all about candlesticks. Before we get started, I would just like to give you a couple of moments to read through this following slide, which is the risk disclaimer slide. So just have a look through that, make sure you agree with everything therein, and then we can probably get started with the webinar. In the meantime, I'd also like to take this opportunity to get you to pop it into the questions box and type in that you can see my screen okay, that you can hear me okay. That would be fantastic. And also a note that, we like to keep these sessions as interactive as we possibly can. I'm here for you guys to ask questions from and talk about any particular markets that you want to, or anything like that. So please feel free to use that questions box facility, and I'll do my best to get to as many questions as I can in the time that we have. So that should, and thanks for the feedback, Dinah and Adrian, fantastic. Should be enough time to have read through that slide. So let's get started by just having a look at what we're going to discuss today. We are going to talk about the often overlooked fundamentals of candlesticks. We're going to look at finding patterns and trends to identify potential trading opportunities. And we're going to do that as a live demonstration on the IC Markets platform. So bear with me while I bring that platform up for you guys. Just like to make a small potential apology as well. I do have a 1-year-old whose bedtime it is, so if you do hear any of the sound travel from next door, then my apologies. Hopefully it won't be too disastrous. Okay, so let's talk all about candlesticks then. And as I said, if any of you do have any questions that you particularly want to ask them, please do feel free. I'd love to hear from you and see if I can help out in any way I can. I'm going to start by looking at the euro dollar as a market. I've got the hourly time frame up here. And one of the things that is on the agenda is finding patterns and trends to identify trades. And I would like to say that that's actually very, very important for myself as a trader. I've been a trader for 12 years, and for the majority of that time I have been predominantly a trend trader, a technical trader. So I would say 99% of my decision making is based purely on technicals, and I am a trend or momentum based trader. So the strategies that I trade are trending strategies, and they go with the flow, with the general momentum of the market. And so it's very, very important for me to be able to identify trends. And I can use candlesticks to identify trends or to identify direction, but there are a couple of other things that I do need to take note of to identify that trend, so that when it comes to reading the individual candlesticks, I have a context within which to place those candlesticks and place my analysis of those candlesticks in order to get the best out of each and every trade. So first and foremost, I would like to a really good question, Dinah. Dinah's asked, what is your main candlestick pattern to consider a good entry? Now, that's a really good question. I wouldn't say that I have one single main candlestick pattern to enter. There are a few different candlestick patterns that I like to look at. I will come to that. I will definitely come to that. I just want to start off just by going through the very, very basics of identifying trends first and foremost. So a trend in the market never moves in one direction in a straight line. And not that line that I've drawn on the screen is particularly straight, but the market ebbs and flows. So for an uptrend, the market will move upwards, but then it will pull back. It will move up, and then it will pull back. It will move up, and it will pull back. And that gives us a series of higher lows and higher highs if we mark out the peaks and troughs in the market. On the other hand, a downwards moving market, a downtrend, would be visible as a move down and then a pullback up, a move down, a pullback up, a move down and a pullback up. And that will present itself as lower highs and lower lows. So that's really essential for my identification of trends. And once we come to actually looking for potential trade entry signals, this concept is essential to that as well. So that's why I want to, even though that's a very basic thing, and I know some of you listening are much more advanced traders, but this concept is key to my trading strategy. So the other thing that I'll point out here is I happen to have some moving averages on my chart, and that is also key for what I'm going to talk to you about with candlesticks. Good question as well. What about range-bound markets? Absolutely, range-bound markets are tradable. Now, there are a couple of ways of trading range-bound markets. Let's say, so I'm going to do it just by drawing an example here, and then we'll try and find an example on the chart as well. Let's say that a market is ranging between these two levels here. Now, let's say this is the daily time frame. And let's say, I mean, nothing ever usually looks this perfect, but you know, I'm just drawing an example here. Let's say this is the daily time frame. Now, a range trader, knowing that there is a strong horizontal level in this area here at the top and in this area here at the bottom, and that I think would have to be qualified by going back in time. Perhaps this is a level drawn on a monthly time frame and going back quite a period of time, over several years perhaps, or perhaps it's just a level that really has been touched and rejected many times and therefore formed a strong level. A trader could look at this level and simply want to buy at the high level and sell, could look at this range and simply want to sell at the top of the range and buy at the bottom of the range. So perhaps they want to buy every time price reaches the bottom of the range and sell every time price reaches the top of the range here. Now, one thing to do could be literally to press buy and sell at the top and the bottom of the range. However, I don't consider that to be a high probability way of trading, and also the reward to risk and where to put a stop loss would have to be a consideration. So for me, if I were to be trading a range-bound market, one of the ways I would potentially be doing it would be to recognize in these areas as price is approaching the horizontal level and as price is actually touching the horizontal level, to look at the individual candlesticks and perhaps look out for a rejection candlestick or a rejection pattern. So something that looks a little bit like, as an example, this one here is quite an extreme example. This candlestick here is a rejection candlestick. Now, regardless of what you name that candlestick, you know, people call candlestick patterns all kinds of different things. Morning star, evening star, hammer, doji, hanging man, all of those kinds of things. But essentially, we don't even need to talk about the names of these candlesticks. All we need to do is see that what's important about a candlestick is it shows us four prices. It shows us an open price, it shows us a high price, it shows us a low price, and it shows us a closing price. And the shape of the candlestick gives us all the information we need. So this particular candlestick here that I've picked out, it has an open price, it has a high price way up here. That shows that the buyers have pushed the price higher, but the sellers have then piled into the market to bring the market all the way back down to a low price, and then the price is closed very close to that low. So this is the body of the candlestick. It's filled in red, and essentially what that shows us is price opened near the bottom of the candle, price was pushed up to the top of the candle by the buyers, but the sellers overwhelmed the buyers at this particular level, pushed price all the way back down, and price closed near the low of that candle, which means that the sellers actually ended up being in charge of the candle. The most important price of a candle is the closing price. That is who won the battle for that particular period of time. Candlesticks shows us the battle between buyers and sellers. And the end of each candlestick, whether the candlestick is on a daily time frame or whether it's on a 5-minute time frame or anything in between, that period of time, let's say it's an hourly time frame because we're looking at the hourly chart here on Eurodollar. For that hour, the sellers were in charge because the sellers pushed the price down towards the bottom of the candlestick. That is a bearish signal, and it usually suggests that price will continue downwards. Now, this has to be taken in context. A candlestick like this, just in the middle of nowhere on a chart, is not necessarily going to give us that much useful information. But in context, let's go back to talking about range-bound trading. If that candlestick were to be evident at the top here, let's just get this a little bit cleaner. So at the top here, price is coming up here and we're looking to sell. And at this point here, I am looking for a rejection of this horizontal level. So I'm looking for price to come up and to reject that level, for the sellers to push price back down and to close back down below the level. And that could be an indication that at this horizontal level, the buyers tried to push through the level, but the sellers took charge. The sellers pushed price back down below the horizontal level, thus potentially indicating that this horizontal level is perhaps going to hold and price is going to stay below this level. Now, if we were to just press sell at this point, then there's nothing really stopping price continuing upwards. However, if we were to place an order for price below that candle with a stop loss above that candle, then we would only be entered into that trade if price continues downwards. If price doesn't continue downwards, if price goes upwards, we wouldn't be entered into the trade, and it puts the stop loss in an area that would prove us wrong. So if I'm entering this trade based on the fact that this candle, the buyers have pushed price up and failed, the sellers have taken charge and pulled price back down beneath that level, that means that I believe that this is the high. This is the high point at which buyers pushed price up, failed, and then price came back down. So that's where I want my stop loss, because if buyers then manage to push price up above this level, then that's where I want to be out of the trade, because that means potentially this was a break of the level rather than a bounce. So hopefully that makes sense. We'll try and find an example of that in the chart later on. So Francis, in answer to your question, no, it's not. Francis was the one who mentioned or wanted me to cover range-bound markets, and is now asking, basically looking for double or triple tops and bottoms. That's not necessarily what I'm saying. Really, in order to trade a range-bound market, I'm looking for something stronger than a double or triple top or bottom, to be honest with you. I'll see if I can find a market that I can show you that on. Now, the other thing about range-bound markets is, let's draw this range in again. Let's say this is a daily time frame and price is ranging. Okay, what that means is that on a lower time frame, for example, let's go down to the hourly time frame from the daily time frame, what's going to be happening is price is going to be trending on a lower time frame while it is ranging on the higher time frame. So we're going to be seeing peaks and troughs in price on a lower time frame, and this may present opportunities, because what happens here is, instead of trying to pick the top or the bottom of the market, and yes, potentially using a candlestick to indicate the potential rejection of this level, but what we can actually do is we can go down to a lower time frame, look at the price action on the lower time frame around these areas, and that is where I would be looking for my double tops, double bottoms, triple tops, triple bottoms. Over here, for example, you can see that on the hourly time frame, what I've drawn in here looks a little bit like a head and shoulders pattern here. So that's a chart pattern that I would be looking out for at the top of the range to indicate potentially that if that neckline of the head and shoulders pattern is broken, price could be going to move down, and if it does move down, it could get to the bottom of the range. The bottom of the range here is a double bottom pattern. So again, looking for these patterns at horizontal levels can be extremely useful, and that double bottom pattern perhaps could be a way into the trade zone, looking for the neckline to be broken there and a stop loss below the lows there, and that could be a safer, more probable way of getting into trading that range without actually having to press buy or sell at the very top or very bottom. Does that make sense? So range trading can be done in a couple of ways, either by using candlesticks at the top and the bottom of the range, or by going down time frames and looking for trend within the lower time frame, within that higher time frame range. So I hope that helps, and I suppose it gives you an insight of my preferred way of trading, where I very much like to wait for confirmation. I'm happy to miss the very top and the very bottom of the market in favour of waiting for confirmation that the market is moving in the direction that I want it to move in before I jump into any trades. So that's range bound markets. What I want to discuss also is trend. Sorry, just catching up with questions. So when the price formed head and shoulders, shouldn't we wait for when it breaks the neckline for entry? Yes, absolutely. So that hopefully is what I illustrated here. So head and shoulders pattern. Here, again, this is a very simplified one, but the neckline would be there approximately. And yes, I would be waiting for a break of that neckline in order to enter. And at this point here, this is where the neckline is broken. Again, one can either wait for a pullback and then look for a move around that area there after there's a pullback, or one can look in this area here and simply look for a strong candlestick signal. So I think it might be easiest if I try and find an example of this. Let me open a chart of Kiwi dollar. Let's see if I can find Kiwi dollar. I'm going to use this chart just because I'm fairly sure I remember an example of this happening. Okay, so it's not really a head and shoulders exactly, but it is an example of where should I take it back to? Let's see. It's an example of a consolidation pattern breaking, and it does happen reasonably frequently in the big scheme of things. So what we've got over here is, I suppose, somewhat of a triple top. It's not a perfect triple top, but quite often chart patterns don't look absolutely perfect. But what we've got here is certain resistance up here, and in fact we can see that resistance coming all the way over here as well, from this previous low. What we've also got is a trend line moving upwards here. So if I just draw that actually in as a bit of a trend line there. So the important thing is we've got this chart pattern here, and what we need to be looking for not only is the chart pattern realization, but how can the candlesticks help us to read this as well? So just looking at this particular pattern here, the candlesticks, we've got a strong bearish candlestick here that closes beneath that trend line. We then have a pullback, so we have the buyers attempting to push price back up, but failing, and we then have another strong bearish candlestick. That's the indication that a downtrend could potentially be beginning. Now I'm going to just mark that out so that when we go down a time frame we don't lose what we're looking at. And so what we've got here is the potential to find short opportunities. And if we then look at the candlesticks, so based on that weekly chart pattern, I've determined that the market is pushing downwards. The sellers are in charge of this market. I'm then looking for a pullback because my chart pattern, this trend line, this upwards trend line has broken, and I'm looking for a pullback to there. And then I'm looking for a suitable candlestick to enter. And this is one of those candlesticks that I was talking about, where it opens near the low of the candle, price pushes up, but then the sellers push price back down and close the candlestick not at the low but near the low. So potentially an entry beneath there with a stop loss above the highs there could be a potentially good entry into the market short based on based on having analysed the chart pattern here and the general direction, and then drilling down into the daily time frame to look for a suitable candlestick to enter. Now, I mentioned earlier context. Context is very important because I would never choose to enter a trade based on a candlestick, no matter what the shape of the candlestick, without context. My context here is I was stalking this area here, which was an area of consolidation on Kiwi dollar. I had plotted out my upwards sloping trend line here along these lows, and I was waiting for a break of that trend line and then a retest. That's what gives me context. Then I can look for the candlestick shape. Excuse me, I've got a bit of a croaky voice. Then I would look for the candlestick shape in the context of where I'm looking for my trade entry. Once I've found that, then I can place my entry just beneath the low of the candlestick with my stop loss just above the high, and away we go. Now, we haven't talked about potential targets yet. That's going to come a lot later. Generally, I mean something as simple as targeting a 2-to-1 reward to risk. With a strategy like this could be beneficial, or a 3-to-1 reward to risk, or potentially 1-to-1 scale out a third of the position, 2-to-1 scale out another third, and then take all profits off at 3-to-1. Gives the move a chance to move down and then pull back, and then potentially we could find another entry in based on another candlestick looking fairly similar. One of these two could be another potential option, one of these ones as well, bearish candlesticks. Now, in order to bring even more context to this, I want to go back to something that I was going to cover at the beginning, which was talking about moving averages, because that is another thing that can bring context. So on my chart here, I have got several moving averages. The moving averages that I have are the 10 moving average, which is this one in black, the 20 moving average in blue, 50 moving average in red, and 200 moving average at the top there. Now, I don't have time to teach you a full strategy in this hour, but what I would say is that when we were talking about the market moving in waves and trend, price action trending upwards, but also moving downwards, so moving up and then breathing in, moving up, breathing in, moving up, breathing in, to give these cycles of price action. Now those cycles, the pullbacks will tend to pull back to an area of equilibrium in price. So price will move down in the direction of the trend, and then price will pull back to an area of equilibrium. And the area of equilibrium can very often be demonstrated by moving averages. By definition, moving average is an average of price. And by that very definition, price has to come back to its average at some point. So price can tend very often within a trend to pull back to this area between the 10 and 20 moving average and then continue on its journey with the trend. And you can see that happening exactly here. Price is pulling back to the moving average here, it's pulling back and it's not an exact bounce or entry point on the moving average, but it's just pulling back to this zone within the 10 and 20 moving averages. It's doing it over here as well. So with that said, that can also bring context to what we're looking for in terms of where are we looking for these candlesticks to happen. We've ascertained that the trend is down. We've ascertained that we want to trade short with the trend. Excuse me. And so we're looking for candlesticks to help us do that, help us find an entry. But where should we look for those candlesticks? Because if we look for the candlesticks in the wrong place, that could end up with either us losing money or being in a trade for a long time before it heads off in the right direction, or just being in a trade that we end up getting out of at break even or something like that. So it's very important to find these entries in the right place. So I talked about this kind of shape of candlestick. There are plenty of other shapes of candlesticks, and in answer to one of your questions earlier, let's go through a few more candlesticks that I do like the look of. First of all, in answer to your question, is it a simple moving average or an exponential moving average? I tend to use exponential moving averages. Now, because we're not actually looking for an exact entry point on the moving average, it doesn't actually matter that much whether you use simple or exponential, but I prefer using exponential moving averages. Just tend to react a little bit more quickly to the current movement of price, and I prefer them. So these ones are exponential moving averages. Now, some other candlestick patterns that I like trading engulfing candlesticks. Let's see if we can find one here. Let's see if I can find an engulfing candlestick. Sod's law that I can't find one on this particular chart, but there's a really nice example of a bearish candlestick there that is bouncing from around the area between the 10 and 20 moving averages there, and is a pretty perfect example of an entry into an already established downtrend. This price action is already trending downwards, and all we're doing is looking for the high in order to get a move downwards. So entry at the bottom of that candlestick, stop loss at the top, looking for, in this example, if we had aimed for 1-to-1 here, we would have hit it there. If we had aimed for 2-to-1, we would have hit it there. If we had aimed for 3 to 1, we would not have made that 3 to 1 target. Hopefully we would have scaled out of the position at 2 to 1, or potentially actually, and this comes to potential exits from trades. Not only can we look at the candlesticks for potential entries to trades, but we can look at the candlesticks for exits as well. So, you know, we can look at large engulfing or large candlesticks going in the opposite direction. So in this case, large bullish candlesticks. That could give us an indication that perhaps we want to just come out of the trade there, because it looks like that trend may not continue. In this particular example, if we'd have just held with our stop loss up here, eventually we would have made that profit quite nicely anyway. But for those of us that aren't patient enough to wait for all of this sideways price action, of course using the candlesticks could be a way to come out, and then looking for a new entry opportunity once price starts trending again. Could happen over here. Now over here, we don't actually have a particular candlestick pattern over here. This isn't actually a named candlestick pattern, but this is why looking at the fundamentals of candlesticks is very important, because actually we don't need a named pattern in order to know what the candlesticks are telling us. Again, it's a battle between buyers and sellers. And here, let me just zoom in a little bit here. So over here, we have got very indecisive price action. We've got buyer, buyer, seller, buyer, indecisive, buyer, seller, seller, buyer, seller, seller, buyer, pretty indecisive, buyer, pretty indecisive. So we've basically got no decision making happening in price here. But what we do have is, this is actually a candlestick that shows the sellers attempting to push price down. They've failed. The buyers have pushed price back up to the top of the candlestick. Now, what happens then is the sellers have taken over and they have pushed price below where those buyers came in before. So they've got rid of all of those buyers out of the market and the sellers have taken control. So this kind of 3 candlestick pattern here, it's not really a named pattern as such, but this candle here shows a huge shift in momentum from bullish from the previous 2 candles to very, very bearish, because it's taken out the low of these previous 2 candles, certainly taken out the low of the previous 1 candle. And from there, we can potentially place an entry at the low, the stop loss at the high, and away we go. And from then, really all I'm looking for is I'm looking for price to move down and then to pull back up into those moving averages. And once they pull back into those moving averages, I'm just looking for a seller candle. And I'm looking for a reasonably small sized seller candle, simply because that enables my reward to risk potential to be greater, because I will place an entry at the low with a stop loss at the high. So the smaller the candle is, the more reward I can make as price moves down. And you know, if there's a seller candle in this area where price doesn't come below the low and it doesn't enter in, well, no problem. I can either continue to look for those seller candles in this area, or I can wait for price to move into a better area for me to trade. So let's have a look and see. In fact, I'm going to look at some more candlestick patterns on dollar yen and generally the yen pairs. I find using candlestick patterns quite useful, especially in areas where we need a bit of context. So over here, from towards the middle of July, the price over here was kind of stuck. We've got a horizontal level of resistance here that price was struggling against. It had come down to here, but it had come up and price was struggling in this area of horizontal resistance here. This is a weekly time frame. So with context here, what I'm looking for is I'm looking for this horizontal level to break. So I'm looking for trend. I'm looking for higher lows and higher highs here. I've got to move to the upside. There's my higher low. Here's my higher high. And then down here, what I'm looking for is another higher low. Now, I want to get in at the higher low to give myself the best opportunity to make profits out of this potential uptrend. Here's a bullish candlestick. Entry at the top, stop loss at the bottom. The next candle doesn't enter in. So here's another one. Entry at the top, stop loss at the bottom. This actually does enter in. Leaves us in a trade for quite a few weeks, not going anywhere, but eventually it does go somewhere. But this candlestick here is a very powerful candlestick. This is an engulfing candle. And an engulfing candle is where the high and the low of the candle completely engulf the previous candle. So the high and the low of the previous candle are within the high and the low of this next candle. And that indicates a huge shift in momentum. The buyers are really truly taking control of this market. The candle has completely engulfed the previous candle. The sellers have attempted back down and failed, and the buyers have come up, and the candle's closed up near the high. That's a very nice entry opportunity. It happens again here. This is another engulfing candle here. Very nice entry opportunity indeed. So there are plenty of entry opportunities there. Now, one thing I would say is I don't tend to trade on the weekly time frame. I tend to take my direction from the weekly time frame and trade on the lower time frames. So in this case, I would be looking in this area. Once I've seen my bullish engulfing candle, I would then go down to a lower time frame in order to find an entry opportunity. And what better or more perfect entry opportunity than a pullback into this area. Where's it gone? A pullback into this area, and then a retest. We've got the moving averages there also, and this strongly bullish candle here. So again, this price action, these candlesticks are telling us there is a normal, these red candlesticks, the selling candlesticks, there's a normal pullback within the trend, within the uptrend. Normal pullback there. Then this candlestick is actually the sellers attempting to push price further down. So the sellers are in control of the market during this pullback. The sellers push price down to the low of this candle, but then subsequently the buyers come in and push price all the way up above the high here. So the buyers have taken control of this market at this point here. Another potential entry opportunity there. And then after that, I would simply be looking for more entry opportunities where I have bullish candles within this area. Do I win every trade? Absolutely not. It's impossible to win every trade. I don't know a single trader who wins every single trade, but this is certainly a way to, especially with context, it's certainly a way. And look here, we can see how price is stalling in around this area. We've also got another area of consolidation where price is just moving sideways here. And what I would be looking for is I would be looking for a breakout of that. And then I would be looking for an entry. So here, this is the daily time frame. I'm looking for a breakout of this area of consolidation. These bullish candles successively show me that price is breaking out or potentially going to break out. This candle here that closes strongly above these previous highs where the consolidation started, that is a strong bullish sign. Can I enter here? No, I can't, not on the daily time frame, because I don't know. In fact, I know but this is not the low of this move. The low of the move is here. The price has come up here. So if I enter here, I could just be entering at the high before another pullback, which makes no sense. What I need to do is wait for the pullback. So I've either got to wait for this pullback here on the daily time frame. No problem, I can wait. You know, one of the most important qualities of traders is patience. So sometimes we do need to wait days, weeks, even months for a trade to set up. No problem, I can wait. I've got this pullback. The sellers are bringing price back down to the area of equilibrium within these moving averages. And then here, buyers come back into a control, entry at the top, stop loss at the bottom, away we go. So I could wait for that. However, why not go down to a lower time frame? So let's mark this in here. This is where the price really breaks out of this horizontal level. So why not go down to a lower time frame? Let's try the 4 hourly for starters. See if we can find where that is over here. Let's go down to a lower time frame then, 4 hourly. Notice the trend, notice the pullback to within these moving averages, and then really any one of these after a pullback. So here's the pullback, just one bar in this case, but it brings us within these moving averages. There's the buyer candle there, entry at the top, stop loss at the low, away it goes. Alternatively, another pullback here, and there is a very small but bullish candle there. If you can see that, let me, I've got quite a big screen here, but I guess not everyone's watching on a huge screen, so let me try and blow that up. This is one of those bullish candles that I was talking about there. Entry at the high, stop loss beneath, and away it goes. Even this one here, entry at the high, stop loss at the low. This one here as well, entry at the high, stop loss at the low. That one may not have entered in, depending on how much space you give it above the candle before you place your entry, or may have entered in and stopped out. But if it entered in and stopped out, all we need to do, given that this is still an uptrend, we're still looking at higher highs and higher lows. There's no reason, even if price comes a little bit lower, no reason to assume this trend is over. All we do is look for the next entry opportunity and take that one. And if we lose a small trade here, well, then we can make plenty of profit to cover that loss and then some when we do eventually get the right trade. And then again, as price pulls back into the moving averages, there's another bullish candle there, another one here. So plenty of opportunities to get into this market on the 4 hourly time frame, for example, where on the daily time frame we were having to wait all the way till around here before getting into the market. Now, if I now go to the hourly time frame, there's the possibility that there could be even more opportunities on the hourly time frame as price pulls back towards these moving averages each time. So we can see here, for example, all of these pullbacks and then bullish candles in these areas here. There's a nice bullish engulfing candle example, entry at the top, stop loss below. And then there's another nice bullish one there. This one, now let's talk about candlestick size, just simply because the size of the candlestick, what we need to use candlesticks for is for using them to tell us what is happening in the market. Are the buyers in charge or the sellers in charge? Because that will determine which direction we want to trade. Do we want to buy or do we want to sell? We want to go with the overall direction of the market, the market flow. So if the buyers are in charge, then we want to buy because the probability is that the market will be pushed in that direction. However, so this candlestick here, very much tells me that the buyers are in charge. This big green candlestick Price has pulled back to within these moving averages, the 10 and 20 moving averages, and this big green candlestick tells me the buyers are in charge. So why not put an entry at the top with a stop loss at the bottom? Because chances are the price will continue in that direction. It's strongly, strongly bullish, this market. Well, the reason I wouldn't personally choose to do that is because in comparison to all of these previous candles here, this is a very, very large candle. And if my entry is at the top and my stop loss is at the low, that means price has to move a long way just to give me a one-to-one reward to risk. Price has got to move even further to give me a 2-to-1 and give me the chance of getting those higher reward to risk opportunities. So using a big candlestick, even though this big green candlestick does tell me that the buyers are in charge of the market right now, it doesn't necessarily give me the best entry opportunity. So that's something that is worth making note of. We need to be a little bit careful about which candlesticks we use as our entry opportunities, simply because not only are we looking to pick the right direction, but we want to take a trade that gives us the highest probability chance of success and the highest reward to risk opportunity that we can find. Yes, these very large candlesticks can tend to happen during the news. That's one place that they can tend to happen, or they can tend to happen, you know, just at the when the market opens. You can sometimes get some strong movement. These candlesticks can, you know, the larger candlesticks can happen at any time, but very frequently they do happen during the news. Very frequently I find the large candlesticks that happen during the news can tend to be quite indecisive, because the market can tend to spike but then change direction quite quickly. I'm trying to find an example of that. It happened, I think it happened yesterday on Kiwi dollar. I already had Kiwi dollar open somewhere, didn't I? There it is. Let me just see what happened yesterday. Actually turned out to be a pretty big move yesterday anyway, but at the time that I was looking, there was a very, very large candle, but it was actually quite indecisive. And that can happen at news time. It doesn't really help us with our trading. If we get a very large candle that's indecisive, it's more of a hindrance to trading than anything else. Yes, absolutely. Yes, that's what I was looking to demonstrate, that yeah, yesterday we definitely did have some very, very large candles, and absolutely this candlestick here, I mean, there is nothing to say about that other than that it's an extremely bearish candlestick. It has taken out the lows of the last, I don't know what, 30 or 40 candlesticks over here. It's extremely bearish, but would I want to trade based on that candlestick? No, I wouldn't, because either I have to have my stop loss way up here at the high of the candlestick and my entry down here, which means price has to move a heck of a long way in order to get any kind of decent profit, or I have to put my stop loss closer, but then risk being stopped out if the market does come and pull back. So it just doesn't give me a good technical place to enter a trade. Are there any further questions or any particular patterns or anything that you would like me to talk about? I think I've pretty much covered everything that I wanted to. Very, very basically, we only have an hour, but really I wanted to talk about the most important thing is build a foundation first. So however you want to trade, whether you want to trade ranges or whether you want to trade with the trend, whether you want to trade using support and resistance levels, or whether you want to trade using moving averages, whatever your foundation is, use that as the basis to then look out for these candlesticks in order to give you a more fine-tuned entry into the market. because it can quite easily happen that you know, for those people who are range traders, I'm actually gonna go back to euro to demonstrate this. It's quite a long time ago now, but I am going to use it as an example because it's something that I traded a lot back then. So back in this period here, euro was ranging very much between these lows here and these highs here. Now this is a weekly time frame I've picked up. Let me just mark this out. This range has been very, very relevant moving forward as well, because not only was it possible to trade, once we got to this point here, it was possible to trade from the top of the range down to the bottom of the range quite successfully, and again from the bottom of the range here up to the top of the range here, but also the next time price came within that range, possible to trade a downtrend within that. Next time price came back within that area as well. So this horizontal level here has been very, very, very relevant for trading the euro for quite some time. Now, if we go to lower time frames, we can see that this is the weekly time frame, but we can see on a daily time frame where the trend could potentially start and finish. So we can use candlesticks. For example, on the weekly time frame here, there is a strong bearish candlestick. We could then go down to the daily time frame to try and pick an entry there. Again, another one here. There's a strong bearish candlestick. Long wicks on the candlesticks means price has been pushed in a direction and rejected that direction and come back in the opposite direction. That's a bearish signal there. Again here, these long wick candles suggesting that price could potentially be going to move upwards here at this level. So it's very, very important to have the context of either the trend or of the horizontal levels before looking for these candlestick patterns. And then once you put both together and also potentially start drilling down to lower time frames, that's when you can tend to pick up some really quite strong reward to risk opportunities. And yes, absolutely, practice makes perfect. Absolutely, practice makes perfect. And you know, the one of the keys, as I mentioned earlier, is patience. And as a trader who trades for a living, it's very important to me to conserve my capital when I need to conserve my capital, so that I have capital available when these trades do happen. And so it's not my profession to spend all day looking at charts and getting in and out of trades and not really knowing what's going on. It's my profession to plan, to look at this chart, to have a roadmap of this chart, and to say, look, these are my levels. These levels I've had drawn in since 2015, and yet here in 2022, price bounced from this level, started a nice long downtrend. Basically, for the entire year, price has been moving downwards in a downtrend from this level all the way down to the bottom of that range. And in fact, it's, you know, since we're in quite unprecedented times at the moment, we've come even below parity on euro, which I'm not sure I was even expecting. However, you know, just this trend here from the top of this level here, and we can see a couple of areas where this is a bearish engulfing candle here. This is a Doji candle. I don't tend to trade using Doji candles. The Doji candle is a sign of indecision in the market. But once price decides which way it's going after that, that is then a useful indicator of direction. So these are areas where the candlesticks are telling us that sellers are coming into the market. If we don't trade these candlesticks, then we can at least go down to a lower time frame to find an opportunity in to the market from there. So the candlesticks on the higher time frame telling us the bears are in charge. Then all we need to do is find an opportunity according to whichever strategy we're trading to get into the market. It doesn't matter how long we need to wait or how patient we need to be. Look, there's a perfect one, and I know it's very easy to notice trades in retrospect, but if we look for these candlestick patterns in context, after we see trend, lower highs, lower lows, it doesn't even have to look so perfect. It could be something just as simple as a seller candlestick in the area around the 10 and 20 moving averages after a pullback. Something like this would have been a losing trade for myself, because I think I would have just got pipped into that trade and then it would have come and stopped me out. But I've made enough money along the way down here for that to not really matter. And we do have to take losing trades as well. It's not a perfect exact science. Sorry, Diana, I'm not sure I understand the question. Do you mean how long did it take for me to develop the strategy that I'm using with the candlestick patterns? I'm not sure I could give you an answer to that. I'm always responding to the markets and I'm always back testing. So I'm always looking at the markets and working out which are the candlestick patterns that give me the best results for the strategy that I'm using. And at the moment, I'm tending to use bearish engulfing candlesticks a lot, and I'm tending to use ones that look a lot like this. Those are my two favourite candlestick patterns to use at the moment. I find it very simple as well because it's just a 1 or 2 bar pattern. I don't need to, look at a load of candlesticks beforehand or anything like that. I'm literally just looking for this, and the reason I can just look for these 1 or 2 bar patterns is because I've already decided on the context. I've already got the context of the horizontal levels or the moving averages or the area of equilibrium before I start looking for those candlestick patterns. How long does it take to learn how to identify these? It's a really good question. I suppose it depends how many hours you spend staring at the charts every day. I was working full time when I first started trading, so I didn't have a lot of hours. But then I would say, once I became a full-time trader, for the first couple of years, I did spend many, many hundreds, if not thousands of hours looking at the charts. But it does tend to become like second nature. We do take it for granted now as experienced traders. And if you're looking at the charts and feeling very, very confused, then don't worry about it. Just have a picture beside you of what candlesticks you're looking for, and then see if you can scroll through the charts and just look for those patterns. It will help if you have a printout next to you and an A4 sheet of paper with the candlestick patterns that you're looking for next to you, and what they should look like, and then you can just scroll through the charts and look for those. Okay, so let me just bring back the presentation. Just to give you the contact details for those of you who want to get in touch with IC Markets. They've got a fantastic customer service team, so any questions that you might have, please do get in touch. There's a phone number there, you can phone them, or there's an email address you can contact the support there on the email. They've got all the usual socials as well. They've got Twitter, Instagram, Facebook, so plenty of ways for you to keep in touch and get any further questions answered. So thank you very much. We've run out of time, I'm afraid. Thank you for all of your questions and thank you for being with me today. I do hope to see you at another webinar in the not too distant future. Have a wonderful evening, everyone. Cheers.